All right, let's dive right into this explainer. If you're anywhere near the management of cross-border financial flows, listen up, because the stakes have literally never been higher. Today, we're unpacking a fascinating expert report that totally flips how we need to understand the reporting of domestically sourced income paid to foreign entities. We're talking specifically about the deep mechanisms governing Form 1042-S and Form 1042 withholding. According to this expert analysis, the whole landscape has shifted. We've basically moved out of an era of casual compliance, where a human might look over your paperwork, and squarely into a strict, automated liability model. The algorithms are acting as the ultimate judge now. The margin for human error, it's pretty much vanished. So understanding the implicit assumptions baked into this new digital architecture is absolutely vital to your financial survival.
So you might be wondering, what actually triggers a catastrophic compliance failure in a system like this? Well, because automated data analysis is now fully deployed across these regulatory databases, simply getting your forms in on time, that's just not enough to protect you anymore. Even a timely but mathematically flawed submission is going to instantly trigger automatic penalty notices. And the reason this is so incredibly dangerous is that the system completely strips away human context. It doesn't care about your intent. The algorithms scanning these documents aren't looking at your good faith efforts. They are programmed strictly, and I mean strictly, for data integrity. To the machine, a structurally flawed file is treated exactly the same as a file that's completely missing.
Here is how the report breaks down this compliance architecture. First, we'll look at the regulatory framework. Second, the agent's burden. Third, algorithmic scrutiny. Fourth, the architecture of accurate filing. And finally, the amendment protocol. Okay, starting off with part one, the regulatory framework. The entire foundation of this system rests on statutory provisions that govern payments to non-domestic persons. This framework imposes incredibly strict reporting on non-domestic entities, specifically applying to what's known as FDAP income. That stands for fixed, determinable, annual, or periodical income. It also governs specific statutory withholding and backup withholding regimes. But here is the real-world implication of this FDAP net, and it's a big one. Because this statutory net is cast so incredibly wide, the default assumption of the algorithmic system is that absolutely every single transaction is taxable, period. Unless, of course, it is explicitly structured, coded, and proven otherwise. There's no gray area here. The burden is entirely on the structure of your data to prove an exemption. Moving on to part two, the agent's burden. We really need to dissect the absolute burden placed on the primary actor in this whole ecosystem, the withholding agent. By definition, this is any person or entity that receives, controls, has custody of, disposes of, or pays a domestically sourced taxable payment to a foreign person. I want you to notice the heavy emphasis on action and custody there. Liability is determined by the mechanism of control over the funds. The regulatory system, it genuinely doesn't care about the agent's actual ownership of the capital. It only cares about who physically or legally facilitated the flow of that transaction. Whoever sits closest to that payment pipeline bears the ultimate inescapable reporting responsibility. Implicit in this massive burden is the absolute necessity of strict corporate identification. An employer identification number, or EIN, is strictly mandatory just to participate in this filing process. Social security numbers, systematically invalid. Individual taxpayer identification numbers, also completely invalid. You simply cannot use personal identification even if you're an individual acting as an agent. The cause and effect happening here is deeply rooted in database architecture. The database is built strictly for corporate entity reconciliation. Dropping a personal ID in there creates an immediate data mismatch before the underlying math is even looked at. It triggers an automatic rejection right at the front gate. Now here's where the systemic architecture gets particularly tricky, especially when you look at the difference between Form 1042-S, which is the information return, and Form 1042, the aggregate tax return. The 1042-S provides the detailed individual transaction data, the micro-level stuff that gets distributed to both the recipient and the tax authority.
The Form 1042 aggregate tax return, on the other hand, acts as the master ledger. It consolidates all the total gross income and deductions from every single one of those individual information returns. And a fundamental compliance trap lies right here. Understanding that this master ledger absolutely must balance perfectly against potentially thousands of those microtransactions. So filing those individual information returns strictly mandates the subsequent filing of the corresponding aggregate tax return. Think of the aggregate return as a highly sensitive mathematical tripwire. If you issue even a single individual 1042-S form, you are legally compelled to file the master aggregate return. They are inextricably linked. If the sum of your individual forms is off by even a single digit, literally a penny, from your master return, the system's cross-referencing algorithms instantly flag the mismatch. It is a mathematical trap with zero tolerance. Which brings us to part 3, algorithmic scrutiny and penalties. Let's look at a critical systemic threshold, 250. Filing 250 or more of these returns strictly forces mandatory electronic filing. But what's highly dangerous about this, and honestly entirely non-obvious, is that this threshold applies separately to both original returns and amended returns. A lot of compliance teams manage their original filings electronically just fine, but then they routinely fall back on paper processes to handle their amendments. Well, the system anticipates this exact loophole. If you hit 250 amendments on paper, you are instantly dragged right back into the mandatory digital pipeline, where the algorithmic scrutiny is relentless. We are dealing with a ruthless cause and effect loop here. Step 1, the agent submits data. Step 2, the system analyzes data integrity. Step 3, an automatic penalty is assessed for inaccuracies. When flawed data gets submitted, it results in the automatic generation of penalty notices. No human is reviewing this to give you the benefit of the doubt. But critically, Step 2 doesn't just check your math. The system is looking for structural formatting errors just as aggressively as mathematical ones. There's zero human intervention to hear your context. The algorithms act instantly, based purely on rigid logic. But there is a defense mechanism built into this modern reality. As the expert analysis notes, the utilization of pre-submission data integrity tools establishes a critical layer of reasonable cause for penalty abatement. Why does this matter to us? Because in an environment of strict liability, this is one of your only legal shields. By proactively running your data through recognized verification channels before you officially hit submit, you're basically generating a digital paper trail of your intent and your diligence. You're building a protective, documented barrier against some severe financial penalties. Next up, part 4, architecture of accurate filing. The systemic impossibility of blending data is a massive pitfall. If you have distinct income types, say capital gains versus royalties, separate individual forms must be filed for each type. If you have distinct tax rates applied to the exact same entity, again, separate individual forms must be filed. Absolutely no blending is allowed. Back in the day, a legacy human auditor could parse a blended rate by reading your attached notes or reasoning. But a modern database schema, it simply lacks the fields to accept multiple distinct variables in a single row. The data streams must be completely segregated, or the system just crashes the file. The architecture of a valid form relies on absolute precision. You have to use only valid current year statutory codes. Do not alter the form year or copy labels. Do not leave mandatory calculation fields blank. And ensure exact rounding to whole dollar amounts. There is literally no close enough in this architecture. A stray decimal point or casually copying a label from last year's form doesn't just look sloppy to the machine. It fundamentally breaks the machine-readable logic and immediately summons an automatic penalty notice. Finally, part 5, the amendment protocol. So when the data architecture inevitably fails and a mistake is made, the absolute linchpin of fixing it, the amendment protocol, is the unique form identifier. This is a mandatory system-generated 10-digit number assigned to one specific original form, and it is completely separate from a taxpayer ID. You can think of this 10-digit code as the digital DNA of that specific transaction. Because it acts as a primary key in a massive relational database, losing track of this exact number means permanently losing your ability to communicate with the regulatory system about that transaction. It's that critical. If an error is detected, the logic of correction is a highly targeted, mandatory sequence. Step 1. Identify the incorrect original form. Step 2. Extract the exact 10-digit unique form identifier. Step 3. Submit the amended form using that exact same identifier to overwrite the data. This is not about sending a new letter of explanation. It's a precise surgical strike on a specific database row. You are commanding the regulatory algorithm to drop the old row of data and accept the new one. And the only password to authorize that overwrite is that exact 10-digit ID.
What happens if you modify the unique form identifier during an amendment? Well, it creates a catastrophic duplicate system entry, triggering redundant penalty calculations. If your compliance software alters this ID during an update, you aren't actually fixing the original error. The system reads the correction as a brand new secondary payment. You have just literally doubled your tax liability and created a phantom transaction that you now have to painstakingly untangle from the database.
And this leads us right back to the interconnected nature of the system we talked about earlier. An information return correction means the specific recipient's corrected data is resubmitted. But an aggregate return correction means the master document must be subsequently amended to recalculate the adjusted total gross income. It's a domino effect. Amending a single recipient form inherently throws the mathematical harmony of the entire system out of balance. The master aggregate return must simultaneously be corrected to restore that mathematical harmony, or guess what? You trigger another audit.
The core thesis of this entire structure is captured perfectly in this expert takeaway. Strict liability rests entirely on the withholding agent's precision, as the systemic burden of proof cannot be shifted to the foreign recipient. This whole architecture is built on the implicit assumption that the domestic withholding agent is the ultimate, undisputed guarantor of data integrity. When things go wrong, the systemic burden of proof cannot be shifted across borders. Essentially, you hold the bag. Which leaves us with this final, somewhat provocative thought. As these automated scrutiny systems continue to evolve, ingesting larger data sets with increasingly unforgiving algorithms, is your compliance architecture actually prepared to survive a standard of absolute strict liability? The algorithms are running 24/7, the data sets are growing exponentially, and the margin for human error has totally evaporated. Human oversight is a thing of the past in this arena. So the only question left to ask yourself is, are you truly ready?